All right, I'm going to go ahead and introduce our next speaker. Bruce Harrell, CPA, is native to and has been practicing public accountancy since the 1970s in the TMS area. He and his firm are licensed to practice in both Louisiana and Mississippi. Throughout his career, Bruce has advised farmers, landowners, and oil and gas clients, and is a land, timber, and mineral owner himself. He plans to cover considerations that taxpayers should be aware of and plan for as they begin to receive income from the TMS. He will give an overview of the federal and state tax issues you might need to be aware, and even give some examples of what he has experienced as the activity of TMS has affected his client base and himself. Did everyone receive a handout? Okay. Mr. Harrell? Let's see, you've got that one, so I'll just place this here.
Okay, is it working? I didn't know how to do this. Burnell had asked me to come and speak, maybe give a little Louisiana perspective, and before I did that, just to make sure everybody's here, I was going to play this. I thought this was pretty neat. I asked, the question is this become a commercial play or not? And I said, well, I asked Burnell, has any of the Dows showed up yet? And I just, what you're talking about. So let me see if I can find this one here. I have had a client that was proficient in this, and I thought it was pretty cool just to kind of set this. I thought that might give a little perspective. We know we hit it when those guys show up. I mean, actually, believe it or not, I have a client. Some of these guys, half of these people here, I think I know, knew the gentleman, and I have a little section in there about what he did because, believe it or not, he invested in working interest in oil and gas. He was from Texarkana. I think, grew up around Lake Charles and ended up with an insurance settlement with a lot of the dairymen around there. They know who he is, and he piddled with some of this stuff. And actually, back in the 80s, when it was a Tuscaloosa trend, as I said, my family, I guess, was fortunate enough we still have some of the property. They drilled a well, and it was a dry hole. It was a Tuscaloosa trend, and it's pretty interesting because I still have a piece of rock, which is, I guess, the shell that they had in there, and they were all excited about it coming in. Said, we just can't keep it coming. You know, they would do whatever. This was before fracking and all this kind of stuff. And you know, I'm gonna mention a little bit about those of you guys. If you ever get to Dow's, run out there and decide to invest in some of these little small wells, because it was pretty common back in that time, even up here in Mississippi, that people would put together drilling groups, and you know, 10 guys would put up $10,000. They could take $100,000 back then and give it a try. I don't know many that were that successful, but some of you older guys may have knew some of those people, and one of the geologists was around here that promoted a lot of that. Well, let me back up. Let me get my outline on here. Everybody really, I don't know that I need this because everybody should have an outline here. When Burnell asked me to do this, I just sat down and I listed a bunch of things that I think people consider when you're doing this. As a CPA, we're not attorneys, even though we get a lot of legal questions. Some of the stuff I'm familiar with and be glad to share with you, but we had two really good guys. I sat in on the first two here, and they really made some really good points, even things that I hadn't considered. And but just to give you an idea, you know, when you're around here sometimes, or leave here sometimes, people kind of look at you. I guess everybody can hear and see me. And I kind of got this thing, I go somewhere, and in fact, one of the most moving things, I went up to Hot Springs Village, Arkansas, with my wife. Our kids were gone, we started playing a little golf, and I get up on the tee box, and there's this elderly gentleman there, and he was really in bad health, and I walked up there and I said, how are you today? And he says, son, I bet you I can tell you where you're from. I've never seen this guy before. He says, I bet you're somewhere from between Vicksburg, Mississippi, and Hammond, Louisiana. I said, how did you know that? He said, well, I'm from Chicago. He said, I worked for the railroad. I was in Vicksburg for a long time, and it's something about you folks down there all sound the same. So I'm hoping maybe that y'all can understand me and my accent or whatever it is, and you know, because I guess we do sound alike. Some of these guys do know me. Another thing that was strange about that, I was down in Marrero on the West Bank. My oldest daughter was in a terrible automobile accident, and she got airlifted. I'd never been there before myself, and I was sitting in the room there talking. This lady kept looking at me, and I said, you know, it's like she knew me, but she didn't. You know, she says, where are you from? I said, I'm from Kentwood. She says, I love the way you people up north speak. So anyway, I was born in Magnolia because that was where the first hospital was that people from Kentwood went to. My grandfather moved to Kentwood back in the 20s. He was hired as the wood superintendent for the Roseland Box Company. And I think they lived in little camper cars on the Tickfaw River out there. They bought a house in Kentwood, which we still have there in Kentwood. My wife is from St. Helena Parish out in Pine Ridge community. I tell them a lot of them I wasn't real smart. Back in the day, I played football at Kentwood, and she was a cheerleader at Greensburg, which, as you know, was in those days a big rivalry. And, you know, but we We ended up tying my last year. I don't know how we finished on the last play. I was able to throw a touchdown pass to the guy because I was really in trouble when we were behind. But anyway, I grew up in Kentwood, have a lot of friends because in those days, anybody south of Galesburg went to Kentwood. And my grandfather was, I guess, an entrepreneur. We had a company called Harrell Gas, which we had till 1972, the year I graduated from college. And I told them, I guess, if they hadn't sold that business, I'd be driving a gas truck instead of doing this today. And got a lot of friends from that area. Like I said, we had a lot of gas customers in the southwest Mississippi, Florida parishes. Since I went to Baton Rouge after I graduated, I went to Southwest here my first semester, and I almost got lost coming up here today. But you know, I'm glad to see, as you know, everybody paid a little money to listen to this, and it's all going to the scholarship fund, and I think we had a pretty good group of people, so I think that's great that they will benefit from that, and hopefully I can share some stuff with y'all that would be worthwhile. After I finished school in '72 at Southeastern in accounting, and went to work with one of the older firms over there, LA Champagne Company. I spent several years there, and one of the guys, it was his dad had started the firm LA Champagne. His name was Sidney Champagne, and he was the tax dean at LSU Law School, and gave me a lot of insight because we have some real wealthy clients in the oil and gas business, and that's where probably I got my first exposure to that. And I stayed there for a while, and I could mention some big-time players in the oil and gas business because Baton Rouge, obviously, with Exxon and all of that, there were a lot of people, there were a lot of landowners that came into Baton Rouge from the Plaquemine area, New Roads area, and all that kind of stuff, which has always had a real strong oil and gas background. Also, growing up through this time, just to give you a little history, if you remember, the Tuscaloosa Trend was the big thing, and it was real hot over in those particular areas, and also over in the edge of Livingston Parish. Back in those days, some of the things that I remember, we had probably, when I left there, I went to another guy who was a sole practitioner, so I was really involved in the stuff, is we had a family from New Roads. I think they were the second wealthiest family out of the Tuscaloosa Trend. And what happened over there was this guy was kind of a character in his family, but they were big landowners. And what they would do is, because they would, if you ever, word's going to get out, you're the big guy in the Tuscaloosa Trend. So everybody wants to sell you something. So how do you keep that from happening? I don't know how good a job we did on that, but everything that was proposed to them had to come through the CPA firm because that's just kind of how you use the CPA firm as an insulation to keep that from happening. But, you come in and you'd hear this guy's name was Boise, that he just bought his and her Rolls Royces pink, he and his wife. So, it's amazing what some of this stuff does to people when, if you're fortunate enough to get it. And, but we had, got a lot of experience there, then we came back, and then when I finally moved back to home and started practicing, I did have clients over in the Livingston area, which there were, at that time, quite a bit of stuff going on, and even the town over there, they were leasing the streets and everything. They tell me that's another indicator when it's really getting close is when they start going into municipalities and start leasing the streets and all those type of things. And the rental payments were good, the royalties were good, but one of the things I guess it showed me is eventually they'll kind of pretty much dry up. So that's another thing that you have to, and I think that you need to look at when you're talking about these investments. So, given all of that, which really probably didn't mean a whole lot to you, I'm going to make a couple of comments here. Like I said, I'm not an attorney. One of the things that we have to always do is, disclaimer, because And I'm going to go through that because, again, we're advisors and so forth. And I've got it, the disclaimer that we have to do because you want to realize that our job is to help you understand the CPAs, what you're doing, and make you make the right and best decision. So facts and circumstances are so critical. We're always on the defensive that we're giving the right answer. And one of the reasons we are because we're not always sure we got the right facts and circumstances. People just kind of have a tendency not to tell you everything. But one of the things that this is give you a little history here before we talk about the particular issues. I put in this quote by Judge Learned Hand, and that's a pretty great name. Judge Hand he was born in 1872. He died in 1961. He was a U.S. Court of Appeals judge. He issued this opinion under FDR's days because he did not want FDR controlling everything. And basically, this is quoted so many times in cases. It says, anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the Treasury. This is not even a patriotic duty to increase one's taxes. There is not even a patriotic duty to increase one's taxes. Over and over again, the courts have said there is nothing sinister in so arranging the affairs as to keep taxes as low as possible. Everyone does it, the rich and poor alike, and all do right, for nobody owes any public duty to pay more than the law demands. So don't feel bad about people. Everybody's trying to pay the least amount of taxes that they should. And the key to it is do it honestly and do it legally. Now, considerations. I've got some information, and Burnell said don't get real technical with these folks. They just want to know what they need to do. Well, as a CPA firm, or in a CPA, and like I say, I've been practicing since '72 in public accounting. I guess the most help you can do is planning. That's what I guess you're here to do. What can we do to pay the least amount of tax? Sometimes people just do it. They come in, they get their tax return prepared, and you don't want to pay any more than you got to. You got to be sure that we didn't forget any deductions, forget any provision or whatever. So it's important, I think, a lot of times, if you know you're coming into some money, to go in and plan, because there's so many roles. I talked about the roles of the CPA, like I say. So a lot of times, one of the things I've seen so much here in the last several years is, in our particular area, there really wasn't a lot of oil and gas play. We always wondered why you ride all over the state and you see little woodpecker pumps going. You never really saw any in our particular area. So I know from, like I say, we had on our family a dry well in '85. There was a lot of activity. And you also got to remember that the motivation is so different now than it was then. Then, prior to Reagan coming into office and passing what we call the 1986 Reform Act, believe it or not, the tax rates were 70%. You could hit the 70% tax bracket, and the maximum tax on earned income was 50%. If you bought property, held it for a year, capital gains, basically what you did is you got to exclude 60% of the profit. So, and inflation was going through the roof. People were buying property and financing it 100%. They saw all these write-offs. So he came in and said, we got to slow down inflation. He was in there after Carter. The guy at those times, you could get 14% on CDs and stuff like that. Overnight, everything changed. And I think you really saw a lot of the activity in our area because the investment groups were selling money into drilling funds because of these big write-offs you could get. And the guys, they were actually getting their funding from high-income taxpayers because they wanted the 70% write-off. They wanted to get these oil interests they produce and sell them and take the capital gains. So when that changed and we had this new set of rules, really our taxes didn't go down. We lowered the tax rates, but we took away a lot of those deductions, and they made a lot of those investments not worthy anymore because of what we call passive activity rules. So what we have now is a situation where all of a sudden everybody starts showing up. They want to lease everybody's land, and being involved in economic development, one of the things that I don't know that y'all really realize is back in that period of time, the wells that were being drilled, fracking was only about 10 or 15% of the wells. Right now, they're probably 85% or 90. I don't know if you realize, but we're not as dependent on foreign oil because of that. And it's also because this guy with LSU, back during that period, realized that there was this, especially in our area, this Tuscaloosa marine shale, and they've come in and tried to experiment how to come out and do it. So we've got a whole different form of exploration. We've got a whole new set of rules. But where I was going with it is all of a sudden, and we talked about leases, is everybody was glad to lease, period, just to get some money. That source of income, if you were a landowner, a farmer, whatever, you weren't getting anything. And I think probably what we're going through right now is the fact that you had, we got a lot of people that leasing started about 5 or 6 years ago. A lot of those leases are about to expire, and that's going to change some of the dynamics. But those are things that we got to consider. It's been interesting really in our area in the last probably since the first of the year, this Blaze well down there, because it was all the leases were beginning to expire. A lot of them had 5-year leases. People were coming in and they were getting $200 an acre. Man, they thought that was fabulous. And then some of them, were holding out for $300, and they thought, man, they had made off like bandits. And then other people would call in my office, well, who's leasing it, because I would have numbers, because they were obviously people would come in. And all of a sudden, when we hit like the $300 mark, I think down in our area, all of a sudden people, man, they bid the Blades well. One guy said, but nobody's calling me. You got some numbers. So lo and behold, one of my clients is a pretty big landowner friend. Somebody called and they offered him $250, and it was good. Man, that's who I want to go with, because they did the Blades well. And what was so funny about it is there's another group that came in there and had driven the prices up. He calls the guy and offers him $300. And this guy had not had nobody call him. He was really, he said, so I finally got the courage up and asked the Goodrich guy when he matched $300, and he took it and he was happy. So he came in, he was so happy, and next month, I hate to tell you, but they're up to $600 an acre. He said, don't tell me that. And so, I mean, it's really amazing. I think sometimes we get caught up in this price. We don't look at all these other things that the other guys do. And we've also seen a time that it's hard, when we talk about investing, that it's what will your stomach take? How can you really handle that? But, it's strange how you get caught up into those things. One of the things and I don't necessarily have these in the right order, I'm kind of jumping around, is, when you talk about taxes and how much to pay and what you can take as deductions and what kind of, one of the things that I think you have to be careful about is that the IRS has this Office of Professional Responsibility. They're really getting real active right now because they've had a lot of bogus repairs and so forth. And again, kind of like the Judge Hand, they've got this circular 230 that's been out a long time, and now, we used to have these disclaimers that, any advice you get or whatever, you're pretty much on your own, that if it can't be used to market or try to sell something or get somebody to do something, because, there's penalties and so forth. Now, it's odd, they came out, they've got a new lady in charge of that office, and she doesn't want the IRS to be brought into that. You're on your own, It's kind of like if you send somebody communication, it's privileged, it's confidential. If it wasn't for you, get it back, but you can't rely on it to pay at least the amount of taxes. Another thing that people come in and talk about a lot of times is, it's strange how all this stuff affects them, is because people have come into some money with these oil leases and maybe royalties, and they're kind of scared about it. You know, a lot of people, I've had people that were retired, some of them are veterans, they use the Veterans Administration, poor souls, and what you hear about that, for the medical care. And I had one, he had a check, and he was afraid to cash it because he was afraid it was going to cost him more in VA benefits and stuff like that than what it was worth. But he had already taken the check, and obviously he had to take it. And I don't know. I think a lot of times in some of these situations, and I know there's some other people talking about Social Security and some of those other things, that we tend to worry ourselves to death about stuff that we shouldn't. You know, I don't know that it's really going to upset you, because really the oil and lease money or the royalties, that's not going to affect your Social Security other than if you make over a certain amount, which I have some tables in there to help you look at that. Now, one of the things I'm going to talk about in a minute is, how are those items taxed? But, there are other things. It depends if you're still working. When I say retirement plans, that could be a lot of things. That could be contributions in the retirement plans. If you're not maxing out on that, can you afford to and should you? Also, how much money do you take out of your retirement plans? I'm going over to page 3. Let's see what's over there. And of course, one of the things is we talk about with clients is making the best deal not only now for the future. If you heard those guys this morning, one of the things they talked about was there's a lot of significant clauses in those leases that they may never come into play. Again, you're worried about self to death about something. You want to get as much money as you can. But there and again, it doesn't matter which state you're in, Louisiana or Mississippi, that now that we're seeing some activity and stuff, and these leases are held by that, there's some clauses there that's going to affect how you get paid, whether you'll get future lease money, what other monies or benefits you might get on there. So it's, we help look at that, but again, we're not legal people. It basically, one of the things I mentioned up there, maybe skipped over, is we more or less work as part of the team. We work part of the team with your attorney. In most cases, you're going to need your attorneys. Those leases, if you look at them, they're very complex documents. They had an attorney prepare them. You better have an attorney that's familiar with this. Look at them, or you're going to wish you're going to have made a big mistake. If you didn't. Something's going to come about, because I can see everybody shaking their head, including myself. Gosh, I wish I'd have thought of that in doing that. Another thing I already mentioned about some of the things, if you have governmental assistance, what you got to be concerned about how that would impact you. Timing of income and deductions is big in tax planning, because if you got an oil lease, would you be better off if there was some other income, whether you're going to sell timber or something, can you defer it to next year? So, depending on, because the higher your tax bracket, and we'll show that in the back, the higher your income can be. So another thing is that comes up so often, and I've got a lot of this in the back that gives detailed information for you to understand how you're going to get impacted if you get a large enough lease payment or your royalties are substantial. The sale of oil and gas, mineral interest, I guess, and royalties, there's so many variations of that. Depending on how it is, it could qualify for capital gains tax, which means that you would only basically, and of course that I'm going to talk about, that's not always the case, but it could be from 0 to 15%, could even be higher if your income gets high enough for that to some other things like alternative minimum tax, and some of this net investment income tax, Medicare tax comes into play. Another thing is that when the people come in, I think it's real important when they ask you, one of the first things you'll probably have seen them do is give you a Form W-9 where they get your personal information. Who are they going to report these rents to? Who are they going to report these royalties to? The guy mentioned the division orders. When you get one of those, that's one of the things they're going to want to know. Who does this belong to? Who are we going to report this to as income for the Internal Revenue Service, so it'll match up when you file your tax returns. And on page 3 still. And then sometimes they don't get that right. Again, you got to go back to them and get it correct, and there's ways to do that. Or a lot of times you might have brothers, sisters, whatever, a bunch of people that have interest, and they may want to just put one person's number on there. So you got to get all that straight. And then once they start sending your pay, at the end of the year, you'll get the Form 1099, and like I said, it will either have the rents that you received, or you would have your royalties. Basically on those royalties, they're going to show a gross amount that you received, how much severance tax was paid out of your money, and what the net amount was. And then I'm going to talk, I think I'll talk about that a little bit later, where we're going to report that, and also about the percentage depletion on that you get as a deduction. A lot of times that I hear people, you hear a lot of talk on the street, what type of entity, what type of planning should you have? Should I just stay an individual? Should I set up a corporation, a LLC, or a limited liability company? Should we have partners, family partnerships, trusts? Or in some cases, somebody may have died and the income's still in the state. The succession hadn't been done. And there's a lot of things in there that could tremendously make a difference in the amount of taxes that you're going to pay. Again, those are specialized items. I think you'd have to get one-on-one and talk to people about that. Also, what types of returns are you going to have to file once you create these things? And but basically, in most cases, all of those income taxes are going to flow through and be taxed on your personal or individual tax return. Other taxes, in thinking about these things, are gift and estate taxes. One of the things that I think that I see mostly coming in there is be careful what you give. Of course, gifts have to be irrevocable, which means you can't take them back. And it's hard to tell somebody whether to do that or not. In fact, a lot of times people don't even want to talk about it, so it's really, we're not the ones that initiate that conversation. They're going to come in on their own. One of the biggest things that you go to do somebody's tax return and they say, well, I've got these, getting these checks now, or, and where I'm talking about most here is when somebody sells something like mineral rights. Because what you have to remember is you have trying to not make this that technical, but you have a lifetime unified estate and gift tax credit. And if you remember, when Bush was going out of office, I'll never forget what year it was expiring, and they couldn't decide on what to do with that. And we had a year, and probably, I don't remember what year it was, but it was the year that George Steinbrenner, who owns the New York Yankees, died, and his family was fortunate because there wasn't an estate tax in that particular year. The downside of that is when you die, and depending on what this exclusion is right now, it's 5 million, I think 150 is 10 million, 3, I've got it written down here because it changes every year. Well, the advantage of inheriting something is you get what we call a step up in basis, fair market value, date of death, or an alternate valuation date, which is usually 6 months after that. And if you had a piece of property, and say it's been in your family for a long time, and just use an example, it bought at $1,000 an acre, or was inherited at $1,000 an acre years ago, and now it's worth $10,000 an acre. If you didn't have an estate or inheritance tax, whoever receives that property now has a basis of $10,000. They didn't pay any taxes, therefore if they sold it for $10,000, they'd pay no tax. if it was gifted because they were worried about paying inheritance tax, which doesn't even exist in Louisiana anymore, they're going to get a carryover basis, so just as if they bought it for $1,000, if they sell it for $10,000, they got $9,000 capital gain. So you have to really think, there has to be good reasons to give gifts other than, I think for some reason, not familiar with the laws, realize that we've had some change. Going back to what I'm talking about, the uncertainty of it is, we went through a year, not too many years ago, 5 or 6 years ago, there was no estate tax. Then everybody was scared to death because it was going to be a little over $1 million. They hadn't decided at that time, and it's each year when they do these things, for some reason they keep stepping them up. But we really don't know how long it's because it's not being permanent. Well, a lot of people made a lot of gifts. They did a lot of transfers. They created a lot of limited family partnerships, and we'll go over the advantages of those. But the reason that we were worried about is there were a lot of people that had $1 million estates. If you had a business, if you had very much land or whatever, you had a pretty nice house, it wasn't that difficult to exceed that. Now, you had an unlimited marital deduction, and and there's been a lot of changes, I guess, is what I'm trying to say here. And I've got those back in the chart if you want to look at them. I put some charts on the last 2 pages, but those are things. So, like I said, the thing about it is we don't always know it's going to be the 5 million plus or the 10 million plus. So that's what makes it very difficult to plan. Been involved in some of that stuff here recently, and once you get over those levels, then you got to start thinking about these family limited partnerships. Advantages, I guess, of those, and they're not foolproof, is you've got a lot of property, and they see on them, I guess the thing isn't that you're trying to hide something, but if you saw so many thousand acres of land, or so many hundreds of acres of land, you got to list all that stuff. If you have a family limited partnership, you just put they own 50% interest in the, your trade limited partnership, or whatever your last name may be, or whatever you wanted to name it. Same thing if you had stocks or other type of things, you don't have to list all those individual items on there, and it doesn't draw much attention. Plus the fact that you can give away to where you don't have controlling interest. There are discounts for lack of control and interest. So those are some of the things, again, those are things you need to consider. Right now, I think probably in this area, I mentioned him on page 4, let me back up a minute. Okay, I didn't talk about severance taxes, but the guy earlier did, and if you were in here, there's obviously been a lot of competition between Louisiana and Mississippi as to giving breaks on that, and that is a break to you as a landowner, because they do deduct that before they give you your net check. And show you how significant it is, my firm, we do a lot of governmental audit work. We're working out in St. Helena. And this particular year, I guess whoever, like they were talking about, you don't know who's doing these returns for these oil companies because they forgot to take that exclusion. And in, I think, over a 6-month period, it was $500,000 in St. Helena Parish. So all of a sudden, the reason they noticed is they took $500,000 out of their next payment. And that was the explanation. The explanation was that this oil company had discovered it. They filed an amended return, and they credited their next revenue check by $500,000. And not only that, guess what? We got all these new wells that are coming in. You're not going to get any money on them for 2 years, or until they repay the cost of the well. And I think Mississippi has something similar. I think they just passed something that made it a little sweeter up here. And like I said, when you're from Louisiana and you practice in Mississippi and Louisiana, you come up here and talk to somebody talk. Up here we say thank God for Mississippi, and they say thank God for Louisiana when you're down there, because there is a little, everybody's trying to get these things going on. Sometimes the things that we thank God for, the other one we're not too proud about. But But it is amazing the competition that goes on those things. And those are taxes that you probably don't even think about that impact you. I talked about on here on page 4, just give you an idea if you've done a return or had some of this. And one of the things that Attorney said, you have to be careful, because a lot of people, if you don't see a lot of these things, they may overlook a deduction that you have. And I got income from rentals on oil and gas leases reported by individual on Schedule E, Form 1040, primarily based on the Forms 1099s. Because like he's saying is, unless you want to keep those records and check what they make sure they're giving you the right amount, you're basically taking it at face value. They give you this thing, this is how much you got, that's what your checks were. One of the things, I guess, a lot of this is because of how strong the lobbyists are, is most of these wells here qualify for a 15% depletion, which is on the gross amount that you receive. Basically what that is, there's two types of depletion. There's a percentage depletion, there's a cost depletion. All landowners here, you don't have a cost in this thing. I guess you could, but so basically what they're giving you is they're reducing your taxable income by 15%. You're not paying anything for it. Which could be, if you got a lot of royalty income coming in, that can be a significant deduction. So that's one of the things that you don't want to overlook. So that's something else. The other thing is, which I was going to bottom of page 4, is there is a lot of activity. I think we've got a lot of people that I hear and see, and I've only had one person, I think, in the last 3 years that I've seen do this, but the price is getting up there a little bit, I guess. And again, you don't know how. Our job is not to tell people what to get, because like the guy said, in investments, it's what your stomach can handle. How much are you willing to give up? How much are you willing to take for it? There are people coming in now wanting to buy mineral interest, which means if you're, say, I don't want to ride the well out, I've seen a dry hole, I don't want to do that. And if they come in and offer you whatever it might be, just say $2,000 an acre, and you got some good acres, that's a considerable amount of money. And, it's kind of like, do I want to take it? Do I want to sell part of it? Is I'm getting the right price? All those type of things. But it has been determined that, and there's different ways, again, how your ownership is. That's why I say the facts and circumstances. Whether or not, if you sell that mineral, whether you get and possibly pay the 15% capital gains rate. If you look at some of those schedules back there, there's people that don't have very much income could get probably $50,000 or $60,000 and pay no taxes on it, because of the way the rate schedules are, but and what other deductions they have. So it's really hard to tell you. But even if they didn't, if they were buying your minerals according to the code, it's like an advance royalty payment that you would be able to take the 15% depletion on it. So those are just some of the things that you may or may not consider. Again, like I said, unless you're really have these situations, I guess you don't really care to hear about it, but you don't want to overlook it either. So another thing is there's a provision. Now, one of the things I backed up there, that the people who couldn't take capital gains and all this stuff is, if you're one of those players out there that are buying, selling minerals, you don't qualify for this. You're what we call a dealer. You have to be, an investor type person or an individual who doesn't do that on a regular basis. Another thing that I haven't seen in this arena, but I've seen it obviously from selling timber and stuff like that. If you structure your contracts correctly, you can have what we call tax-free exchanges. The thing you've got to remember here, though, is if you sold your minerals or even your timber, it has to be a lump sum amount. It has to be, and what you have to. Again, there's times, there's identification, it has to be like-kind property. There's a lot of things you have to work out, but it is an opportunity there. If you want to defer that, you can do it. So anyway, that's those particular items. Now, Here's where it gets a little sticky, and this is where it gets a little costly, and these are some things that you're probably going to run into. On page 5, I have this thing called alternative minimum tax. They basically, if your income goes over these amounts, and they're changed every year, if your income exceeds, if you see at the bottom there, $52,800 for a single or head of household, $82,100 for married, $41,050 for married filing separately. We've got a parallel tax system. It says every taxpayer is responsible for paying the higher the regular tax or the alternative minimum tax. The difference between the two, you have this form 6251, and if the minimum tax is higher, you add that to your regular tax, but if your regular tax is higher, and the reason sometimes your regular tax would be lower is you have these things called tax preference items, and they're kind of somewhat listed on page 6. It's not an all-inclusive list, but you basically have to go back and calculate your sources of income and how they're calculated to do that. So, you know, that's where even a lot of things like your tax-exempt interest and some of those things, things that maybe keep you from paying tax. Now, on page 6, this is the new one. This is the one that's just kicked in 2013, and I had a lot of people that weren't real happy about this, so even though we warned them about it, it's kind of like they don't believe it till they see it. And you don't wonder, why is my taxes so much higher this year as last year? And basically, as you know, there's two forms of this. One, the Medicare tax, and this is obviously to help fund that. There's an additional 0.9% and a 3.8% on higher income individuals. And I'm not going to read that, but you know, if you're self-employed, you pay both the employee part. And if you look at it here, the 0.9% starting on page 7, if you have wages or self-employment income over these amounts, if you're married filing jointly, it's over $250, single head of household $200, married filing separately $125, you're going to pay this additional 0.9% Medicare tax. Now, I don't know how many people work and have those kind of salaries, but there are a lot of people out there. There's a lot of husbands and wives, and this is only paid by the employee. Now, the one that most of you will see if you're not working is this 3.8%, which is an additional tax that started in 2013. And what they do is they take, on the side, you have a form and you calculate your modified adjusted gross income, and you add this net investment income. I have, and this happens to fall into place if your income on page 8 is married filing jointly 250, it's a little bit higher threshold, single 200, and married filing separately 125. Now, like I said, if you look at this thing, you take this modified adjusted gross income and you add back all of these things, because we used to have a lot of people that had a lot of investment income, dividend income, rental income, all these type of things. And also included in here is the royalties and rents you receive off of these oil leases. So all of a sudden, don't be surprised if these oil payments are you're going to get hit with another 3.8% Medicare tax, which will be added with your income taxes. So that's something you'll have to plan on. Look at all of those, business things, interests that you might have. Again, time, and there could be things you can do to slow that down. But really, one of the things I think that we have to worry about is people just hate to pay taxes, and the tax rate is still not 100%. So it doesn't make sense to go spend $1 to save 40%, but you still lose another if you're paying on something you really don't need. The background on that is, I'm going to let you read it. It all came about about whatever you want to call it, the Affordable Care Act or the Obamacare Act. You know, it's funny, you see these commercials. I mean, Jay Leno had one on it, and he'd ask people, what do you think about the Affordable Care Act? Oh, we needed that thing. There are some good things in there. You know, people that couldn't get insurance can now buy insurance. They don't have to worry about pre-existing conditions, all those type of things. And they ask, well, how do you like the Obamacare Act? Oh, that's the worst thing that ever happened, you know. But they're all one and the same. And if you are a landowner and get substantial rentals or oil and gas royalty payments, you're going to pay for it. So that's it. Now, on the bottom of page 10, just to give you a little perspective on how all this works, I don't know what time I'm speaking to, but like the guy, the Dowser guy, occasionally, I never really, you know, when we talked about investments, we're talking about risk and rate of return, how much can you do it, you know, there's nothing, you can talk about all the things, the products you want to, it all comes down to that. One of the things that I always thought, I was just watching TV years ago one night, and Jay Leno had Jeff Foxworthy on there, and he was going all this redneck stuff, you know, this is how these people are around home and do this, that, and the other. He says, you ever heard all of that? I still don't understand. He said, what is a redneck? He said, well, it's like this, Jay. He says, you know, smart people, they got 401ks, they buy treasury bills, they got, you know, all these retirement plans and stuff like that. He says, rednecks, they buy lottery tickets. So it's kind of like, how do you feel about your personal finances? But, you know, oil and gas has obviously got to be one of the most riskiest things other than maybe dairy farming, I don't know. They got to be the most optimistic people in the world. But they do have a good lobby, and this on page 10 tells you if you're a direct participant in, say, going out and drilling a well, which there's some people who do like to do that, and the guy that I had that had the Dowser, and like I said, he was good at it. He would go buy working interest in well, and I believe I have a lot of other clients in oil and gas, from cranes to, you know, offshore inspections to, one guy has a huge impact. He's working up in the Marcellus. They probably have 150 land people, and then I get to talk about all this stuff. And every now and then I'll see some of these guys. They'll, you know, somebody or one of their buddies, they'll talk them into putting 10 or 20, 5,000, 50,000 in one of these wells that they're gonna, you know, and a lot of these wells are small wells usually, and I think you see them more over in the western part of Louisiana where we've had active gas, you know, wells. Maybe they've kind of falling off, and they've got nowhere they can go get a little mineral interest and drill a well. You see a lot of it out in Texas because they can go in there and drill a lot of shallow wells and do that. But basically, terms you'll hear, and of course these are those things I talked about. These people, they get too much of it, are tax preference items, you know, and sometimes I think it, like I say, when you're doing stuff, you look at the other side of the fence, how does that process work? And it tells you right here, if your direct participation in oil and gas can generate several tax benefits. I don't know if some of y'all are going to be getting all this money. If y'all want to go around and participate in drilling a well, this is how it works. This is what you can deduct. There's a lot of things you can deduct up front in tangible drilling costs. That's a term you probably heard. It tells you what goes in there. Basically, all these leases and stuff that they're paying you, they get to deduct right off the top. Then they have the completion costs. They get to depreciate the equipment. They get the depletion just like you do. And a lot of times you notice there's some special deductions in here. They even go out there, and wells producing less than 15 barrels a day, they even get an extra. They can bump it up to 20%. And then also there's credits that they get in relation to the oil and natural gas production. So that's pretty much that. And then also there's the alternative minimum tax. There's some special things on that, lease operating expenses that apply to those particular operations. And for those who invest in oil wells, this tells you an overview of what it might be to you. Now, one of the things that I was supposed to hear to talk about was Louisiana income tax. And I said that's probably the easiest part, because in Louisiana, the personal income tax is just a piggyback on the federal tax. And so the things that you're concerned about, especially people that are out-of-state people that might have some royalties, whether they're even the same things in Mississippi or even in Louisiana, you know, depends on whether you're resident, non-resident, or part-year resident is how you do that. And also the nexus determines where you pay taxes or where that income's connected to. So basically, once you file your federal return, you come over and calculate. There will be some adjustments to get your Louisiana adjusted gross income. Your federal income tax is a deduction to come up with your Louisiana taxable income. You look it up in a chart or a table, and the rates are 2%, 4%, and 6%. The highest rate I think here in Mississippi is 5%, but we're pretty close as far as what the taxes are between the two states. There's not a lot, like I said, the severance tax is a state tax, but you know, this is pretty much the things that you have to determine. But also, if you are a resident in Louisiana or vice versa, Mississippi, you don't pay tax to both of them. In Louisiana, you pay all of your, if you're a resident, you pay all of your income is taxed in Louisiana, but if you also had to pay tax in Mississippi, you get an offset or credit for that. Vice versa, if you're a Mississippi resident, you pay a Louisiana tax, you get a credit there. I know I went all over the place on this stuff, and I put in the very back here just some charts to get, if you want to know what tax bracket these are there. There's a lot of questions people have about Social Security. If you go over a certain amount, how much of it becomes taxable. There's these alternative minimum tax rates thresholds are there. How much you can put in retirement plans. But the thing you got to remember is, again, those are hard to answer unless you know all the facts and circumstances. And that's why you pretty much have to get together one-on-one. There's a lot of things in here that's going to raise your taxes. Is the higher your income, there's also a lot of phase-outs. If you don't know that, you can lose your personal exemptions, you can lose some of your itemized deductions. And then, of course, I have the gift tax exclusion on that table. You can give, last year was 14, and this is federal at 14. You can give that without having to file a gift tax return and use part of your lifetime credit. Like I said, last year, just to give you an example, the exclusion, you know, was what it was per individual, $5,250,000. It was this year it's $5,340,000, and if you go over that as a taxable state, you're going to pay 40% of your estate. So that's when you're going to have to do some planning. If that kind of upsets you and you don't want to do that. But anyway, I think I may have skipped a few things. I didn't really know how to approach this. I just thought I would just make you aware of some things. Anybody have any questions?
Page 3, Bruce.
Okay.
Tax returns.
Now they basically phased out the corporate franchise tax, but LLCs are not subject to that. If you had a company or you had a lot of capital in there, you would pay could pay several $1,000s in corporate franchise taxes, which no longer exists. So, but what happens is you have to once you do that, you have to determine what type of entity for tax purposes you want to be. If you're single, you can be a single member LLC, you just report that in your personal tax return. Then, or you can elect to be an S or small business corporation. You have to file a separate return. There'd have to be some reasons for you to want to do that. But that income is basically going to flow down to your individual return, but you're going to have to file a separate tax return.
But the question was, you offered a service to evaluate individuals, which one of these entities would be most tax advantage, provide most tax advantage? Yeah,
what you would do is a client comes in, says, here's my situation. What's the best entity for me? That's why I say you have to know the facts and circumstances. And then you go and say, well, here's the advantages of being a corporation. These are the advantages of being a S, a small business card. This is the advantage of having an LLC, which could be any one of these, or would a partnership be best for you? The thing that you have to worry about, like in partnerships, and some of those, it also depends on the nature of the income, is if you have what we call earned income, which is self-employment, like it's wages or being in a business profession, you have to pay, in addition to the income taxes, 15.3% self-employment tax. Now, the rents that you get from these oil leases are not that. So you might say a partnership, especially if you had a family partnership, because the thing about partnerships, you can have differences in how you share in profits and losses, how you share in capital. In S-corps, it's got to be equal depending on the ownership interest. There's a lot of little quirky rules, so it's a hard question to answer without knowing the facts and circumstances. There's no really one answer for all. One size fits all.
Give guidance.
Yeah, that's what you do, is you go and do the calculation, do the what ifs, and determine which one's best for you.
I created an I'm sorry.
No, go ahead.
I'll get both those.
LLC for my brothers and I on ours, and my question is, I know we can deduct certain things, attorney fees, CPA fees, and when we put our property into that LLC, the description and everything in that LLC, since the royalties are coming out of the property, which is a part of the LLC, if we were to do any improvements on the property, i.e. put in fences or whatever, is that a deductible expense if we do it as an LLC and is pertaining to that property, or we go buy a tractor? Are those items deductible versus just personally getting the money? Of course, you're taxed up front. But can you create an LLC, get your royalty money into your LLC, and describe your property into it? Can you deduct certain expenses?
Well, yeah, and you know, the thing about, here's the thing about it is, just because you have a LLC or something like that doesn't mean every deduction is a business deduction. You have to differentiate between business and personal. The thing about what I was saying, the family limited partnership, what it does, it just makes it easier to manage. Rather than if you have undivided interest, then you buy a tractor and there's three of you, each one of them's got to deduct 1/3 of the tractor. One of you's got to deduct 1/3 of the fence if it's used for farming or agriculture or business or whatever. But if you put it in one entity, you do one tax return and each one gets a schedule with their percentage of that. And that makes it a whole lot simpler to put it in your tax return. And also, like I said, the real advantage is, I think that, of course, every time you move into one of these areas, and the IRS doesn't like it, and they see, getting back to Judge Learned Hand, if they think you're doing it for tax avoidance, they're probably going to change the rules. Because one of the guys I was telling you earlier in my presentation, a guy that taught at LSU, an older guy, and he made it very tough. It's like being in the military working for him. But he always would give us a little bit of his wisdom. He says, look, taxes are never going to be simple. They're never going to go away. He said, because not only is that the way the government funds themselves, that's how they control the economy. This is such a, and everything that, I think we've gotten in this situation to where obviously they've spent more than they've ever taken in. And now they've got limits, they pass laws, and that's why it's so difficult to anticipate. Right now, I brought some stuff, we have so many laws. It's just like I gave you this chart. We got charts on just about everything, about what provisions are expiring, which ones have been extended, which ones may get extended, and it's making it very difficult. There's stuff that is sunset or expired that they may decide to extend. You got to realize they only got a week or so left in session. They got to go home and politic because they got to get reelected. Some of them are going to come back. We're going to have a lamed up Congress. There's no telling what we're going to get. But I hope that answered your question. But all of that is part of the thought process in answering all of y'all's questions. Is you just got to look at it and do what you can. It's harder to do long-term stuff. Did you answer?
Yeah, I was talking. You were talking about the difference between the stepped-up basis and the carryover basis with reference to inheritance tax and gift tax, and the lifetime exclusion now that is, I think, what is it, $5 million?
It was $5,350, I think.
Okay, so if And that's the value, they value, let's say, your mineral interest at the time of donation, right, the act of donation.
Right.
Purposes to determine whether you've done your lifetime. In addition to your lifetime exclusion, you get 14 or 15 grand.
Right. Per donee, that's
That doesn't factor into your
that's an addition.
5 million, right? So I could give 14 grand to everyone here.
Yeah.
And that wouldn't cut in. Okay. So then, in evaluating whether it should go through probate and it should be inherited or whether it should be donated, is essentially analysis on how much of the lifetime exclusion's been used up, right?
Right.
Okay. All right. I'm just.
But that's an ongoing permanent record that they'll keep, I guess, in your social security number. But here's the thing you got to realize, it takes you a while for some of this stuff to sink in, so to speak, because if you give a gift, it takes away from your exemption at fair market value. But whoever, and it's not a deduction to the person who gives it, it's not income to the person who receives it. But that person that receives it
has to pay the increased taxes
because they get the carryover basis is so low.
Right.
But yet it took away from the person that gave it because their credits deducted or reduced by the higher. And that really doesn't seem right, but that's how it works. I don't know if I helped y'all. There's a lot of things I think, again, that, it's obviously the dynamic thing is constantly changing. It's very hard to plan because of that. I mean, there's so many things. If you've got businesses, obviously you can buy assets and expense them so much, and there's all kind of special rules. There might be but you got to be careful because there could be limitations. You just can't say go spend 100 grand and write off 100 grand, and that's against your income, not your tax. That type of thing. So you got to really put it down and calculate it. We spend a lot of money learning these programs. We got sophisticated programs. I wouldn't even try to do it now with pencil and paper. I used to when people come in, I'd always because usually when people come in, I usually meet with them, get their stuff, and I always try to say, what's the tax gonna be, and then when I get through, how close did we get to that? What did we overlook, or what else can we do, or something to do that? And so it's pretty hard to do it now, especially if you look at all these adjustments, and you've got all kind of special rules, and one guy's active in a particular piece of business he's got, another guy isn't. It's just like if you've got a small business and you say that business generates $200,000. Okay, if he's an active participant, he doesn't pay that 3.8. If he's not an active participant, he's just an investor, he does. On that 3.8, on that investment income, that's added back, and he gets it if his income's over the 250. And so you got a lot of what ifs in there. It's kind of like you plug them in and roll the dice and see how we come out. And then it's always kind of been a joke about, they always at the first year they'll give a tax return to a group of accountants and see what kind of liability you come up with. And they all come up with different ones. And they said the good one was the one that said, what did you want it to be? But really, you don't have that kind of leeway.
Unfortunately.
But anyways, anybody else got any questions? Like I said, I figured one thing I was glad to do this is I learned more myself coming up here and asking some questions or seeing what people are dealing with out there that we don't see. As a rule, we probably do 750 or more,
If acquiring a mineral interest, or
so what?
If you're acquiring a mineral interest, do you have to issue a 1099 to that individual that you're paying?
Yes, you should.
You do.
Because it's an exchange.
Right. Okay. I heard something earlier today and I couldn't believe it, but
I would say yes. My opinion is that you would, and of course, these people, like I said, we have this term called dealer status. These people say, come and say, we're interested in buying your minerals. That's their business. They do it on a regular basis. So it's not a capital asset, it's subject to all, ordinary income tax rates and all these other things. If you as a landowner sell it, you're not a dealer, you don't do that for a living, that's an occasional thing, you're an investor.
Well, yeah, but there's no right line rule as to whether you do it, you know.
Well, there's a lot of gray areas and all of that kind of stuff, you know what, and really a lot of times there's no definition. It's kind of like your facts and circumstances. You have to do that and be able to justify it, so. Anybody else? I was expecting a lot more people, but after I saw the attorneys here and they had the Louisiana group and the Mississippi group, it's kind of like, there's a lot more folks from Mississippi here than there is Louisiana, but anyway, thank y'all. Had some good questions. Anybody else? I'll be around if anybody else wants to ask me anything. I'll do my best to, if I don't know the answer, to find it for you. So thank y'all again.
Thank you.
Thank you.